Bitcoin is on the verge of an important update that aims to refocus the cryptocurrency on its role as money, but Michael Saylor has given 110 reasons why this upcoming soft fork might be actually a bad idea. Meanwhile, Hyperliquid now allows anyone to launch their own applications without permission. The chances of the Clarity Act passing in the US have dropped drastically, and Drake, along with a few other gambling-heavy personalities, lost millions in crypto because Spain became world champion in football. With these stories, we kick off the week, gang. Drop a solid like and comment for support, and let's get started. The crypto market hasn't shown much volatility lately, and things are honestly pretty boring. So we're jumping straight into a topic that split the Bitcoin community into two camps. This is BIP 110, an update that aims to limit the amount of data being pushed into Bitcoin blocks for about a year. This includes restrictions on scripts, taproot features, and several mechanisms that enable ordinals, inscriptions, and other non-financial data. Supporters say this will reduce spam and make nodes easier to run. Opponents, however, see something much more dangerous, changing Bitcoin's consensus rules because of a dispute over a use case that is fully valid and pays fees. Michael Saylor joined the debate, presenting 110 arguments against the BIP 110 soft fork. According to him, Bitcoin must remain a completely neutral system that doesn't divide transactions into good and bad. He says the network's rules are the strongest aspect of Bitcoin and therefore shouldn't be changed just because some people dislike a particular type of data. In his view, changes to the core rules should occur only if there is a real technical problem that threatens the network, not because someone thinks a transaction is spam. Saylor also points out something critical. Bitcoin has no idea what the data inside a transaction actually represents. The network cannot tell whether it's an image, a contract, a proof, or a future application. It only sees bytes. So if restrictions are introduced on how this data can be structured, it could affect perfectly normal financial operations that simply use more complex scripts. Another strong argument he makes is that BIP 110 closes many doors to future development. Just because certain features aren't widely used today doesn't mean they won't be important tomorrow. Limiting parts of Taproot and other mechanisms could block future ideas, smart contracts, new types of wallets, more advanced security systems, and various Layer 2 solutions. According to Saylor, this could scare developers away from Bitcoin because they'll know that valid constructions can be temporarily banned if someone decides they don't like them. His biggest concern is the precedent. If consensus rules are changed once to restrict a specific use case, the same could happen to another tomorrow. This could open the door to future conflicts, division, and politicization of the protocol. Saylor sums it up clearly. The proposed cure is more dangerous than the condition. In his view, BIP 110 doesn't solve a critical technical risk, but it does create new ones: uncertainty, division, and limiting the freedom to build new things on Bitcoin. Share your thoughts on this update. Are you for it or against it? The next story comes from Hyperliquid, which released an update called HYP4 that essentially opens the network to everyone. Until recently, only select teams could launch new projects on the protocol, but now any developer can create their own application without requesting permission. This is a big shift because Hyperliquid is known as a decentralized platform for fast trading and derivatives, but until now it has been relatively closed off. Now it becomes more like an open marketplace where anyone can experiment and build new ideas. This means more projects, more competition, and much faster ecosystem growth. Developers can now deploy their applications directly on the main network, not just in a test environment. This could lead to new types of markets, trading tools, automated strategies, risk management systems, and much more. Whether this will attract new teams and make Hyperliquid an even stronger competitor remains to be seen. But one thing is clear: once a platform becomes fully open, it usually grows much faster because it no longer depends on centralized approval. So the next few months could be very interesting for Hyperliquid and everyone following the project. We jump to the US, where the chances of passing the so-called Clarity Act have dropped sharply to just 31%. This bill is supposed to clarify which crypto tokens are considered securities and which aren't, something that's a huge problem for American companies and investors because the regulatory environment there is extremely unclear. Many projects don't know whether they're operating legally, whether they can offer certain services, or whether they'll receive a letter from regulators tomorrow. According to reports, Donald Trump's latest attempt to break the deadlock in the Senate didn't change anything. The two major parties remain stuck and the bill simply can't move forward. The drop in odds means that change is unlikely in the coming months. This could push even more projects to leave the US for countries where the rules are clear and more predictable. Some analysts believe that if the bill doesn't pass soon, the country risks falling behind in crypto innovation, because companies won't want to operate in an environment where they don't know what's allowed and what isn't. For investors, this is also a problem. Uncertainty always leads to less activity, less capital, and slower growth. So the Clarity Act, which was supposed to bring clarity, now only brings more confusion and delays. We'll see if the political situation changes, but for now it looks like the US crypto regulation remains stuck. We stay in the US, where last night, as everyone knows, the World Cup final was played and Spain convincingly outplayed Argentina, winning 1-0 after extra time. Matches of this caliber attract massive bets, and this one was no exception. Popular rapper Drake placed $1.5 million in USDT on Argentina to win, and many people, after seeing his bet, were almost certain Spain would lift the trophy. The reason is simple: Drake is notoriously unlucky and the teams or athletes he supports often lose, which led to the phrase the Drake curse. The Canadian wasn't the only one who lost a huge amount because of Argentina, who last night looked completely lost and out of place in that final. Look On-chain revealed that one crypto trader placed $1.23 million on Argentina at a moment when they were massive underdogs. The potential payout would have been $12.3 million, but you know what happened in extra time. Another bettor made the right call, putting almost $2 million on Spain and winning $1.35 million. That's where we wrap up, friends. Have a great start to the week and see you tomorrow.